and welcome to Money Life. This is Sucheta Dalal. This week we talk about retail algos all over again. 3 months ago in July, I had talked about how the Securities and Exchange Board of India seems most reluctant to regulate retail algos, although the number of people trading those algos had increased exponentially, and most of them are new investors who have been attracted by a raging bull market and have no clue about stock markets, stock price movements, and how badly they could hurt when things get wrong. But SEBI had, or at least someone in SEBI had said, we've discussed it internally and don't see the need to regulate. Well, the good news is that things have changed. Over the last week or so, this SEBI has been meeting a bunch of people from the market, brokers, as well as people who write algos, or algo retailers is what I would call them, and has been trying to figure out what is the market, how does the business function, what is the income, what is the equation with the brokers, and what are the points at which regulation is badly required. That, like I said, is good news. But let's look at what the market is all about. So, as of now, almost all the top brokers allow algo trading. So, they have what they call application program interface, which allows a system, that's your computer, to connect to the broker system and trade automatically. So people get API access. They also subscribe and buy algo, which they want to trade from these algo retailers. And people who want to trade algos get the API from the brokers and then subscribe to an algo retailer service. At the moment, there are about 40 odd algo retailers who offer maybe 350 trading strategies, which are all separate algorithms with a separate monthly subscription. These subscriptions range from 500 to 1200. How big is the market? Well, 80% of cash trades on the National Stock Exchange, which is a near monopoly, are in algo trades. Bulk of them would be institutional algos who have their big servers co-located or located inside the exchange and operate at a completely different level. Retail algos have a more slow feed, but they are also automated, programmed trades, and they are offered to retail investors whose investment size could be anything from as low as a couple of lakhs to even as much as 100 crore at the high net worth end. How many of people are trading these algos? According to an estimate, the number who have registered are humongous. So one algo retailer says he's got 50,000 registrations, but about 5,000 to 6,000 active traders. And the estimate is that about 100,000 people are very active trading daily with algos. That is a huge number because remember, this is very, very rapid transactions, automated, which trade to a strategy through a machine, no human intervention. Now, how are these algos offered? How do you get them? So as people said, you just search, you get Google ads, and the algo writers contact people. Brokers by and large pretend that they are not offering algos, though they all have equations including profit sharing and commissions which are paid to the algo retailers. The algo retailers say that they are listed as remisers, which means agents who bring business to the broker. So SEBI has strict rules for sub-brokers. There can't be more than one sub-broker. There are KYC rules. So all this is avoided by designating people, all kinds of influencers and algo traders who bring in business as remisers. Most people who trade actually think that these are sub-brokers, but they are not. And some algos actually allow one tablet or one computer to have multiple trading accounts. So some of these remisers, who people think are sub-brokers, are even actually running a portfolio. So they become small portfolio managers running 5, 6, 10 accounts from one computer. So the person who's actually trading is only given his money to an algo retailer, and the retailer is trading it through his app. Some sub-brokers are also doing this. It is not legal. They are not registered. But like we said, SEBI has been reluctant to regulate it even now, even when things have reached a danger zone. The ferocious bull market like we're seeing today, where even the big stocks can move about 10 to 15% in a day, it is so easy to entice people to come into this market because there's a promise of easy money. And nobody is regulating the advertising and the false promises. So while mutual funds are supposed to say mutual fund investments are subject to market risk, these algo retailers are actually assuring 10 to 15% returns per month. And this naturally brings people rushing in. And this whole system of referrals and commissions that's going on is almost like a multi-level marketing strategy, because big brokers, discount brokers, need rapid trades, need algo trades in order to earn enough money. And when there are more people coming in, obviously they're willing to pass back some of their even meager looking commissions. Some algo retailers realize that the party can't go on forever, and they've been trying to persuade SEBI, writing to them saying, tell us how to get registered, because when the music stops, they don't want to be caught with the bad guys who are writing bad algos. Remember, algos are coded programs which can be made to do anything. Nobody really knows what's behind it because retail algos are not being checked. So people who are in the market say that you can actually code an algo to do market manipulation, to do pump and dump operations, for dealing in penny stocks, for tax avoidance. No one is looking, and it's time that the regulators started looking. So people in the industry itself, like I said last time, have been asking the regulator to create an opening for them to be registered and turn fully legit. Some others realize there's a problem coming, so they've registered their companies abroad so that they're probably out of the purview of SEBI altogether. Now, contrast this with how stringent SEBI's rules are for regular investment advisors. They have so much of red tape, but I'm going to come to that later. They have documentation, capital adequacy, certification, and justification of trades, but nothing absolutely for another set of people who are offering advice through coded programs. Now, sensible regulation would require SEBI to have the same registration and qualifications for algo retailers. They would have compliance requirements. They have to think it through, because many of these are small shops which, if they're made to follow the same capital adequacy requirements, could possibly just fold up their legal operations and go underground. This doesn't help anybody, doesn't help regulation, doesn't help investor protection, and doesn't help the market. But there has to be a balance, there has to be a level playing field between the kind of stringent rules that SEBI has inflicted on investment advisors, absolutely stifling documentation, which has been happening over the last 5 years, and a complete free-for-all when it comes to retail algos. So let me quickly run you through some of the issues that are involved. One, algo retailers do not even require registration. Like I said, no documentation, as opposed to registered investment advisors and registered research analysts who are subject to capital adequacy, educational qualifications, market certification, etc. You need a level playing field. Second, algo retailers have no KYC requirements. They don't even bother. There is no documentation. There is no filing. They don't worry about whether their algo is suitable for the client's requirements, what is the risk appetite, or any justification. All of them provide clients with some backdated information. But as they say, lies, damn lies, and statistics. So you can pick 2 data points and backdate things to the most attractive results, and this may not actually happen in real life. This yawning gap needs to be bridged urgently. So you need algo retailers to be compliant, but in a manner that they can do business legitimately. Algo retailers have been allowed to have referrals and commission relationships with scores of brokers. Now, how does that work out? What is being sold? It cannot be as non-transparent as it is, because remember, we are seeing so many broker defaults which have not been clearly analyzed as yet. Many registered sub-brokers are executing trades for investors, since algos, like I said, enables them to manage portfolios. This is not their job. SEBI rules for portfolio managers are even more onerous They have a minimum capital size of 50 lakhs, up from 25 lakhs earlier. They have a capital adequacy requirement of 3 crore. So imagine that you have this for a qualified, legitimate portfolio manager, and a sub-broker is able to trade 6 portfolios, manage them for clients who know nothing about the market. SEBI has refused to budge on portfolio managers' onerous rules, even though that it is clear that it's not just people with 50 lakhs who need professional portfolio management, but even people with 2 lakhs and 10 lakhs would like to have professional advice or have somebody who is an expert manage their portfolios. SEBI does not allow it by the kind of red tape that it's built around it. Yet the same SEBI until 3 months ago felt algo retailers do not even require regulation. Now, since algo retailers are not registered, no disclosure rules at all, nobody even knows what are their proprietary trades as compared to the algos. No one knows what access to data they have from the algos that they write, which flows in from the clients who are subscribing to them, whether proprietary trades are done through a separate algo written by the algo retailer, which may be working at cross purposes from what they're selling. I mean, all this applies even to television journalists and what they're recommending. But this market has been allowed to flourish with absolutely no rules. I mean, obviously, this cannot go on. Since there's no scrutiny, the regulator and investigating agencies also don't know if there is any manipulation, how bad it is, and how much of it is going on. Most traders also are completely unaware of how algos work. For instance, they don't know that if there is a glitch or there is a slowdown in the data feed, then it can distort how the algo works. Most people don't even know this. Now, this was evident in the outrage we've seen over the last 2 months about the sudden sharp spurt in what they say were NSE prices. As it turned out, there was nothing illegal going on because retail algos, while they think they have a machine, are updated more slowly than institutional algos working through co-location sites. These trade in microseconds, as in 1,000 microseconds make 1 second. And in those 1,000 microseconds, an institutional algo program can push through high volumes of so many trades that they can catch profit opportunities probably 100 times over before the price reflects on a retail algo's data feed. And so it looks like a sudden up or down spike. This was causing huge losses, and people have learned the hard way to figure their way around it. And with NSE also trying to educate people on what kind of positions that they can take with algos. Now, the way forward for SEBI is not to make people learn through losses and trial and error. It has to come forward with a quick framework for registering algo retailers who provide research and investment advice, like I said, through program trading. The framework has to cover registration and execution of trades because that's what an algo enables. The more complicated task for SEBI would be to find out which trades are generated through APIs. Now, which is how to separate regular trades from the API or algo trades. People who are trading say that it's easy to do it. They say there is a separate format for orders that come from co-location. Similarly, there can be a separate format for orders that come through APIs. It is not difficult, but SEBI has to work on it. There also needs to be separate registration for investors seeking APIs with terms and conditions and some sign off that they understand what they're doing and what they're signing up for, or even understand that profits are not guaranteed on a monthly basis. Algo retailers also want some limits because they themselves are aware of how fast are the programs that they're writing, and they think that it's quite possible that if there's a sharp market movement, your entire capital can be wiped out in a day. When that happens, there'll be pain, there'll be anger, there'll be demand for refunds. There will be talk about why SEBI has not regulated the market. So if there are some checks and balances, if there are trading limits, at least people will be saved from their own folly. And indeed, this is the job of a regulator. Investor protection, even from their foolishness to some extent, is probably the job of the regulator. So SEBI is moved from not needing regulation to the fact that it needs regulation, and people who offer buy-sell recommendations have to be accountable for what they do. My only point is, when SEBI does it, it needs to be more comprehensive in its outlook. It can't have extremely strict rules for regular traders who are in fact safer, who are not giving you machines to run down your capital in an entire day. There has to be a level playing field. So SEBI needs to do two things: regulate algos to make the market safer, create a level playing field between investment advisors, research analysts, portfolio managers, and this new breed that is coming in. And no, SEBI robo-advisory is not taking care of the problem. You need to sit and frame new rules. And it's good that you've started it. If you like what you've heard, subscribe, pass the message. There are so many new traders, they need to know what's going on. Thank you.